From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, a large bid comes back into short-term bonds as the Fed looks closer to ending its rate hiking cycle. And that bid gets bigger as the job market shows broad signs of softening. And traders are starting to price in rate cuts earlier next year. We're going to begin with the big issue. Does a weaker labor market actually signal that the Fed's fight is nearly over?
Look at the economic data.
The jobs report.
It's always important.
Incredibly important.
The labor market is the key right now.
Certainly, we're seeing a slowing pace over the last few months.
The payrolls report was picture perfect, I would say, for the Fed, for the equities market, and for the bond market.
For the Fed, it's a really big deal now that you're starting to see labor be symmetric to what you're seeing in other parts of the economy.
Goldilocks for markets and consistent with a soft landing for the economy.
I do think it's consistent with a somewhat softening labor market.
The momentum and the sentiment around soft landing is going to be pretty hard to push back against.
I think this takes the wind out of the sails of those who wanted to go further.
I think on the whole, this is going to be welcomed both by markets and the economy.
Now, this is a chart that's going to make you dizzy, because if you look at the 10-year yield that hit that critical level of more than 5% just less than 10 days ago, October 23rd. And since then, you've seen a more than 50 basis point move downward in yields. I'm talking 54 basis points. We're looking at 453 on the 10-year today. And it's a massive change in expectations for a market that had been expecting higher for longer and now is starting to reprice. How drastically, though, are they repricing? If you flip up the board here and take a look at rate expectations into next year, you have the market starting to price in cuts earlier and earlier into the year. You're seeing the Fed swaps starting to price in as early as May or June to a greater degree the expectation for cuts from the Federal Reserve. Now, the problem here is how tight are financial conditions really, and is the Fed's job actually over? We caught up earlier this week with former New York Fed President Bill Dudley, who thinks the markets and Powell could be done.
He feels very confident the Fed has done a lot. He feels policy is restrictive. And so I think, the market's taking away the notion that he thinks he's done. And one problem I think the chairman has at this point is by talking to the markets in a sort of supportive way, stocks rally, bond yields fall, that's loosening financial conditions. And so that's removing some of the restraint that was creating some impetus for not tightening monetary policy further.
Now, joining us now is BlackRock's Gargi Chaudhuri and Sanctuary Wealth's Bartels. Gargi, let's start with you on that notion that Bill Dudley had brought forward, because what he's trying to say here is that the more the market, the Fed thinks it's over, the harder the job is for the Fed, who is trying to tighten financial conditions more. So how does this play out through the rest of the year and into 2024?
Sure. Good afternoon, Sonali. It's so great to be here. Thank you. I think recently there's been a huge amount of focus on financial conditions tightening. But what we have to remember is while that is, of course, important, and Chair Powell introduced that in the FOMC statement, ultimately what's going to drive their behavior and price action and policy is going to be the trajectory of the labor market and the trajectory of inflation. Yes, financial conditions obviously matter. They've been tightening, and then now they've unwound a little bit of that tightening. But I don't want investors to think that that's the only driver of what's going to lead Powell to either ease, stay on pause, or hike from here.
Marianne, when you look at today's job report, what do you think in terms of this idea that there was a broad enough cooling to suggest that the market is softening enough?
I do believe that investors are taking it that the Fed is going to stay on pause in December. And we're going into year end. And we have to remember there's a lot of shorts that have been positioned in the 10-year. And if you're going into the end of the year and you think that the Fed is on pause, you're going to start covering those shorts. So I think part of the violent move that you pointed out earlier in the program in terms of rates falling around 54 basis points, part of that is not just buying, but part of that I think is also short covering. So I think we need to also put part of the move into perspective.
Well, the short covering, I'm glad you brought that up, because can rates at this point move higher just as fast as they've come down, Gargi?
I think a lot of it will depend. Actually, next week is a really important one. Let's see how the market responds to the supply coming into the market, because before this week, the driver of long-end interest rates, the bear steepening that took place, was very much driven by the concerns around deficit. It was that term premium move that we saw. So now, when we look at next week's auctions in the Treasury market, the 3s, the 10s, the bonds, let's see how the market responds to the 30-year auction in particular, which has, if we look at the auctions since August, all of them have tailed pretty meaningfully. The takedown for non-dealers has been trending lower. So I think the yields, certainly yields can be range bound from here, 4.5% to 5%. I don't think this is the beginning of a vast move lower, especially for the long end. I think where there is tremendous value actually is the belly of the curve. So the 3 to 7 year part of the Treasury curve is where we think investors should be positioned.
I want to talk more about the long end, because if you look at what Janet Yellen had said this week, I want to pull up a quote. She had said that having regular and predictable issuance of maturities across the spectrum, both long, intermediate, and short, is critical to have deep liquid markets for U.S. Treasuries, which is critical to lowering our costs over time. At present, the duration of the portfolio is about the longest it has been in decades. Now, this idea, guys, has been a massive dispute in the market. Billionaire Stanley Druckenmiller said he's surprised that the Treasury Secretary has chosen to exclude the $8 trillion on the Fed's balance sheet that it is paying overnight in repo rates. And when you think about this dispute that's happening, and what he's saying is that it doesn't make sense to exclude that from their calculations. Marianne, how do you make sense of the long end of the curve when there is this massive frustration in the market from large investors that they didn't finance earlier at the longer end? Do people start to get in longer duration at any point soon safely?
Well, at this point, it shoulda, coulda, woulda. So whether or not they should have, they didn't. And so that time has passed. You really got to move past that. But I think part of the discussion that's not happening in terms of supply is who is a potential buyer. And that potential buyer is the individual investor. At least at our firm, we're seeing our clients want to lock in interest rates. Now, we're talking about laddering. And that you want to be across the curve, because we do think over time the risk is that rates will eventually go back up again. But I think that we're not talking about the individual investor that has not had income from the fixed income market for 16 years. And if you're moving into retirement or in retirement, locking in a rate around 5% is very attractive. And of course, we're seeing this a lot at our firm. So I'm not as concerned about supply, because I think we have a very large buyer in the market that no one's talking about.
How much, Gargi, do you think the U.S. household can step up? And how much do you think the levered hedge fund at this point, another hot topic in the market, has to step up?
I think the leveraged hedge fund story is obviously the big one, given the viciousness of the move in the long end. I think we all know that the household has to be that marginal buyer now. I'd argue that they're a lot more price sensitive than perhaps other buyers have been, whether that's foreign institutions or central banks. So I think the level of yields matter, which is why, especially for the long end, where you're earning less than you are in the front end of the curve.
Now you're talking to the American retail investor. Where do you buy in, Gargi?
I would say buy the longest part you go is the 7-year point. So buy the 5-year, buy something like an IEI Treasury bond ETF, which gives you right around that 5-year point of duration, and it turned positive in terms of total returns for as of today. I think that is the longest you go. And yes, households can step in, but let's remember that they're very price sensitive.
Now, how do you, Marianne, look at the yield curve from here? There has been a lot of dispute about whether you buy steepeners at this point, and if you start to do that, where you buy in. How are you thinking about that dynamic?
So the yield curve has steepened in a way that we're not used to. We're used to the yield curve steepening by the front end of the curve going down, and we actually steepened by the back end. And I'm in the camp that the traditional economic models that we're using are not working as well as they used to. And the reason for that is the amount of stimulus that the Fed has had, going all the way back to the great financial crisis, to COVID, to now also having fiscal stimulus coming into the market, and that's going to start in 24 through 2026. So I think trying to analyze the fixed income market, trying to analyze the equity market has been very challenging because of the amount of monetary stimulus. So I'm right now in the camp that at least we're going to enter 2024 on a positive economic note. We're starting to get early signs that the consumer is slowing, but they're not stopping. So that means economic growth is probably going to continue. So I would agree that the back end of the curve can stay pretty choppy between 4.5 and 5. But if we're getting softer economic data, you're going to see the front end of the curve come down, expecting the Fed to cut. So that's kind of how I would analyze the move on the yield curve.
We have to leave it there, but our thanks to BlackRock's Gargi, Chaudhuri, and Sanctuary's Marianne Bartels. Got to have some positivity to end the week here. Up next is the auction block. Ford returns to the debt markets after getting a blue chip upgrade. More positivity. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg's Real Yield. It's time now for the auction block, where a high-grade weekly volume nearly doubled projections in the United States. You had names like Morgan Stanley, Hyundai, Bristol-Myers, and Humana all coming to market. There were more than $30 billion for weekly issuance in the investment-grade sector. You also had Ford tap the market, the same market, for the first time since returning to blue chip status. It borrowed $2.8 billion over two parts. And when looking at forecasts, the debt issuance surge is expected to continue this month. Banks project up to $100 billion of blue chip sales. And speaking of credit, earlier this week, Torsten Slok of Apollo said there are still risks to the market.
Credit investors should be asking themselves, are you compensated by buying the passive index according to the risk that you're actually taking? Or might you be taking more risk, in particular in lower rated credits, especially in high yield, but also lower rated credits in IG, where the spread simply at the moment is so high simply because the base rate has gone up. So in that sense, I would expect to see, as the economy slows down, which is what the Fed is trying to achieve, that you should expect to see credit spreads widen over the coming months.
And joining us now is Tannuzzo of Columbia Threadneedle and Matt Toms of Voya Investment Management. Gene, if you hear what Torsten was saying, and if you pair that with the issuance we're seeing, investment grade is still getting some love. But at this point in the cycle, the economy is clearly starting to show some signs of softening, as shown by the job market. But what does that mean for the investment appetite for anything that's riskier than investment grade?
Yeah, it's a good question. And I think Mr. Slok asked the question, do you want to own the passive index? And I would say the answer is no, but are there opportunities within that universe worth investing? And I think absolutely there are. It's absolutely true that dispersion will be increasing as we move into 2024 based on the higher cost of capital and at least deceleration in the economy, similar to what we've seen in this morning's labor market report. But if you look, for example, across the high yield market, there's huge dispersion by credit quality, with double B companies, the higher end of high yield, having interest coverage above 5.5 times, but those triple C companies just a little bit more than 1 times interest coverage. So a little bit of shock to earnings and demand, or a little bit of shock further to the cost of capital, and you can run into a tricky situation very quickly. So I definitely think there are opportunities when you're looking at a yield north of 9% for the full high yield market. I would argue those opportunities exceed what you see in the equity market, but you have to be very careful given the changing economic backdrop.
You know, Matt, it begs the question, when you see treasuries, the safest market in the world, whipsawing the way they are, how safe is safe? And even in the investment grade landscape, how discerning do you have to be?
So we think that base yield is actually quite attractive in that interest rates on corporate debt can compress because of the dislocation of treasury yields higher. So the investment grade market to us looks very sound. You're at a 125 spread. And the demand you see in the long end of the curve from pensions looking to lock up liabilities and insurance companies is quite strong. So from an individual investor standpoint, you can bias towards the middle of the curve, the middle of the yield curve and credit curve, and get quite a lot of income. But we do not see an imbalance in the corporate earnings space on the IG side that's going to create a downside. I think Gene's right. Higher rates, that we've been insulated from the general economy, but we're not we're not inoculated against higher rates. And the more speculative grade companies, the low end, can begin to see some headwinds, but I do not expect it to be broad-based in the investment grade space.
Now, when you think about where spreads are today, do you see an entry point at which you would start to get into even riskier areas, Gene?
I absolutely think so. And I think first, to start with the investment grade market, I would say the overall spread is average and fundamentals are in generally a very good place. Demand is not the problem, as Matt was just saying. But if you look within the market, again, it's a story of dispersion where cyclicals and industrials look very expensive. I think banks, which tend to be an intermediate maturity asset, their debt, look very attractive. And we look at the big banks where, they've largely have the flexibility to deal with some of the unrealized losses and those headwinds that come from higher rates. And their spreads are quite elevated relative to more cyclical industries. We think there's a buying opportunity now within investment grade banks. As you move down into the high yield market, I think, again, it varies, but you have to keep in mind not only the yield and spread, but the dollar price where you're buying those assets. In high yield, your downside is a default and ultimately what your recovery would be. And your starting dollar price is 80 to 85 cents on the dollar in a lot of these bonds. So that's going to insulate that downside. And I think the next cycle where we see spreads widen, it's likely that they get out to maybe 600 or 650 basis points rather than the sort of 1,000 basis point barometer that's often viewed as an economic or a credit cycle.
To the extent that you see opportunity in banks too, Matt, do you see an entry point there that's reasonable for you? And do you have to stay at the end of the biggest of the big with all the concerns that are going across the sector?
That's the place to start, and then you move incrementally in. The middle-sized banks still have real estate concerns. There's still funding volatility. This rally in rates certainly helps. But that real estate concern talks about what's going on as well in the securitized markets, where you still have a lot of cheapness in AAA assets where banks can't lever it, REITs can't leverage it. And so the dislocations create attraction to where you don't have to go heavily down in quality to buy AAA assets in a 150 to 200 spread, or you can buy high quality banks. But as opposed to going down in quality in banks, I'd rather go to the mortgage sector where you can monetize high volatility, or into the securitized sector where you can get equal or higher spreads at a AAA level.
Well, expand on that. Where do you see opportunities in mortgage and securitized products at this point?
So agency mortgage backs are a pretty safe and boring investment over a long time. But in today's environment, you get a 6+% return on a AAA asset, which it's not a matter of if you get your money back, it's when. And with rates having hit a 5%, we think cap near term, you're defining the top end of the range. Volatility measures are starting to decline in the 10-year. Not so much the Fed space, but in the 10-year space. That should support vol lower, which will increase the price of very high quality assets that are AAA. Also in the CLO space, you can play the high yield space that Gene was referencing. It's winners and losers. Another way to play that is AAA at a 150 to 200 spread is another way to play bank loans with subordination benefits through securitization.
Now, I'm curious, Gene, when you think about risk-taking here, where do you see kind of opportunities if you're going to take on credit risk? I'm definitely one of those people that are probably watching distress and bankruptcies more than your average correspondent here. And so to the extent you can take on some credit risk, where do you go?
Yeah, I think, I'd break it down first between the consumer balance sheet and the corporate balance sheet. On the consumer side, we are starting to see some weakness, particularly in the lower credit quality, lower income borrower. So when we look at areas like securitized products, like non-agency mortgages or asset-backed securities, we're being up in quality. We're positioning up in quality in those areas in AAA and higher quality investments there. When you look at the corporate space, I think we just want to be, frankly, a little bit less cyclical. If we look at some of the industries like metals and mining or chemicals or some of the energy industries, there's a lot of good news priced in. I think that soft landing is priced in. But if you look away from those sectors, the more stable, less cyclical industries, we mentioned banks, but also insurance, also utilities, some of the food and beverage and defense names. I think those are really stable areas where we still find good value. And I think that the risk return profile and the all-in yield is still very attractive.
But Gene, if you look at the opportunity here in terms of a soft landing, what happens if you start to factor in a potential for a hard landing? Do you think that scenario is not yet meeting the market yet? And what's the risk of it?
We have not priced in a hard landing. I think that we should be very clear about that. And in that scenario, I would expect a couple of things to happen. One, you'd expect credit spreads to be widening significantly and more signs of demand destruction. Frankly, that demand destruction hasn't really been there. Yes, we can talk about non-farm payrolls slowing a little bit, but top line revenue growth at these companies is still in the mid-single digit range in general, consistent with where nominal GDP growth is. So I would expect those credit spreads to widen out, but I would also expect, based on some of the more recent evidence that we've seen throughout the course of this year, different than 2022, that risk-free rates would be falling. And now they're in a position to do so if we see that demand shock. So to be very clear, we're not pricing in a hard landing now, but what we do have is a significant risk premium with much higher yields that can cushion the blow to the extent we tried to transition to a slower growth economic backdrop.
Our thanks to Gene Tannuzzo of Columbia Threadneedle and Matt Toms of Voya Investment Management. Still ahead, the final spread. The week ahead features more comments from Fed Chair Powell. This is Real Yields on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread, the week ahead. Coming up, we get Monday, BOJ minutes and Eurozone PMI data. And Tuesday, we have a number of earnings kicking off, including UBS and Uber, as well as KKR. Finally, we have Thursday, Jay Powell speaking once again. And then the day after, on Friday, you have Christine Lagarde speaking over for the ECB. And one final thought before I let you go, because in addition to public markets, I'm looking at the private ones. The way to beat higher for longer rates in the private market means more borrowing. You have private equity firms taking out PIK loans at 16%. If you think 5% was a lot on the 10-year, take a look at what borrowing costs look like if you're borrowing more to stave off future or current borrowing costs, rather, into the future longer. Now, listen, from New York, same time, same place next week. That does it for us here for Bloomberg Real Yield. This was Bloomberg.